You can't wake up and say it's 2022. I'm going to invest in 3 apartment buildings and 7 mobile home parks and 4 self-storage facilities like this year. Because if you're doing that, you're actually it's the exact opposite of the filter system, because then you're actually forcing those things to happen. I have no idea what I'm going to find in a given week. And so I have to respond to it, but I have to be very disciplined about it.
Welcome, everyone, to the Road Less Traveled Show. This is a show about people that were successful in a previous career and left that career to go down a different path. I'm your co-host, Richard Coyne.
I'm your co-host, Bill Zahller.
On today's show, we have Jeremy Roll. Jeremy, we're so glad you're here with us.
Thanks for having me, guys. I really appreciate it.
Absolutely, Jeremy. Well, thank you for being on the Road Less Traveled Show. Can you tell us a little bit about your background, what your first career was, and then how long you're in that field?
Yes, and I think this is a very appropriate show title for me. So I'm from Montreal, Canada. I spent a few years in the corporate world back in Montreal after undergrad. And then I came to the US, did an MBA over at the Wharton School at University of Pennsylvania. And I spent years in the here in the US in the corporate world at a couple of small companies, but a couple of very large companies too. Like Disney headquarters was my second to last job. My last job before I left the corporate world back in 2007 was Toyota headquarters here in Los Angeles. And I ended up on the road less traveled, which is I left the corporate world back in 2007 to become a full-time passive cash flow investor, which I started doing in 2002, but I got out of the corporate world in 2007 from the cash flow. So it's going to be about 15 years in mid 2022 that I've been out of the corporate world and full-time passive cash flow investor, but I've been doing it. It'll be 20 years that I've been investing in this type of stuff in February, just in a couple months.
Wow. Seen several markets in the last 20 years for sure.
Yes. And we're recording this now at the end of 2021. The Fed literally today just announced that it's going to be tightening quantitative easing, possible 3 rate hikes next year. So there's a lot going on today, but between getting through the pandemic, what was already a record long economic cycle going into the pandemic, which has been extended by stimulus and all kinds of crazy stuff. As an investor, which I'm sure you guys can appreciate, it's very hard to predict what's going on. And what's killing me is that with all the government intervention, it makes it even more challenging to predict because they kind of step in and change the path of what would have been a different path that you were maybe trying to predict. So it's a very interesting, challenging landscape right now.
Yeah, the billions, trillions of dollars being printed, it's been going on for the past year and a half is unbelievable in terms of how much the money supply has expanded, and that's leading to where we are right now, which is rate hikes and inflation and things like that. So yeah, it is challenging.
Like so with all the outside stimulus too, it's hard to predict. Like so, there's almost no normal business cycle anymore. When you think it correctly, they pump more money in and it extends it out, and you kind of, like you said, it's harder to kind of read what would be a natural correction or when it should unnaturally occur. Anyhow, with the what 40% of the new money added in the last 18 months to the money supply, I mean, it's unprecedented, obviously.
Yeah, I heard that. What's interesting is that people, I think, misunderstand when the Fed says it's going to tighten quantitative easing. All that means is that it's going to continue to buy more assets for another few months. And then it's probably going to have about $9 trillion on its balance sheet, but it's not going to unwind its balance sheet. At least it hasn't said it's going to. So trillion with a T, right? Not with a B. So we're in unprecedented times, to your points. But I am concerned that we might see a proper end of cycle correction adjustment or whatnot, given the current actions the Fed's are about to undertake. So it's going to be interesting to watch. Next year is going to be a very important year.
Elaborate on that for a minute, if you would. Just again, none of us are experts, or certainly we don't have the crystal ball. What could that look like as they begin unwinding certain things?
Yes, and I am by no means, I'm not a financial advisor or financial any investment advisor, anything like that. So this is my perspective as an investor. Well, what's interesting is that if you look at past cycles, and I'm a huge fan of trying to extrapolate, looking at history to extrapolate where things are going. And that's why I get really frustrated by what's going on right now with all this government intervention, because it disrupts, all my investing thesis that I have by looking at all the past and trying to sort out where things are going. Mm-hmm. So, but if you do look at the past, you'll see that what's really fascinating is that 100% of the time when the Fed starts raising interest rates, it leads to a recession and it leads to a stock market correction. And so when you hear about 3 interest rate increases planned for the Fed next year, they just announced it today themselves, and you hear about them stopping the quantitative easing and stopping to make those purchases, essentially, to me, if nothing else changes and there's no more crazy stimulus and nothing else is put into way that we're not projecting, to me, that means that there is a recession coming at some point that seems to be inevitable. And what I've been watching probably most carefully to try to sort out if and when is the yield curve. And the yield curve actually inverted on us. I believe it was in March of 2019. And then we had the recession in March of 2020 that we probably would have had without the pandemic, based off the midpoint of when a recession normally happens after an inverted yield curve. So, I'm watching that really carefully again. The curve is definitely flattening. I watch it every single day. And to me, it's probably one of the best predictors of, are we ending up going down that path or not?
Gotcha.
Yeah.
Wow. So on that happy note, Jeremy, think back to your corporate days, maybe Toyota, maybe one of your other previous companies, Disney you mentioned. Is there a funny story that you can share along the way that's something you encountered that made you think, the corporate world's fine, but I think I want to move in a different direction?
Well, absolutely. Because in fact, my whole story is that I never wanted to leave the corporate world, but I actually left the corporate world because I had a last straw moment with my manager. And in fact, so I wasn't one of those passive cash flow investors who said, I'm going to go down this path and in 5 or 10 years, I'm going to get to that end goal and I'm going to plan it out and it's all going to happen. I actually said after the dot-com crash in 2001, I said, I want a more predictable way to invest. And I started focusing on more passive cash flow for more predictability and get out of the volatility of the stock market. And that was for my long-term retirement investing for 10, 20, 30, 40 years. I wanted more predictability. It was just more comfortable for me because I'm pretty low risk. So, in 2007, I had the paycheck and I had cash flow built up and I just want to keep it that way. I had switched divisions in Toyota from marketing to finance. And it wasn't just a switch within a certain entity. It was actually a switch into new building and a whole new division. And when I came in, my manager was new, came from the field. And long story short, I was managing several pricing analysts, and we were actually determining lease and finance pricing for Toyota, Scion, and Lexus for across 31 regions across the U.S. every week. And the problem with the pricing analyst is that they were very nice people, but Toyota, being a Japanese company, has a very hard time firing people. And so what they do is they move them around. And what happened is that I had 3 quote unquote pricing analysts. And I'll tell you my funny story, which is for those of you who know Excel or just even are beginners at Excel, I sit down next to someone who's been a pricing analyst for years with that title. And I say to her, show me your spreadsheet. Something seems wrong with, pricing this week or whatever. And she brings a spreadsheet up. There's a column, right, with some labels. Column A, column B is just a bunch of numbers. And there's a total at the bottom, right? So for the basic Excel feature is sum feature, right? Sum, rows, B through F. So I said, can you just make some tweaks? And then I said, well, I noticed the total isn't changing. And she says, well, I said, can you total up for me? So I thought she was going to go and fix the formula. She takes out a tape calculator and starts adding up the numbers on a tape calculator. This is a multi-year experienced pricing analyst because she didn't know the sum function. And so that was my funny story because I quickly learned that none of these pricing analysts actually really were pricing analysts. They were people who had lost other jobs and had been moved into this corner of the department. And so I tried to go to my manager. He refused to replace them and hire new people because he didn't want to cause waves because he just got promoted and he was just above me. So he said, you're going to have to do their jobs. You're going to have to come in over the weekend. And that was the beginning and end of it. So the truth of the matter is I had a 6-year signing bonus to switch departments and I had the promotion myself. And at 6 months plus 1 day, I gave my notice. So that's my corporate world story that made me get out of the corporate world. So it lines up perfectly with your question today.
So I years ago when I was in college, I worked for an organization that was part of the federal government. And, in a way, probably similar to Japanese companies, there sometimes are people that just get moved around and get just sort of like, even though they're not a motivated employee, even though they may very well have, some personal matters or whatever behaviors that are just not appropriate, they just still stay there years after years. This one particular lady, I kind of think it was an act. she would walk up and down the hall. And this is again, picture just a big room, not even cubicle walls, just desk after desk after desk. And she would walk up and down the hall, muttering to herself, sounded like a crazy lady. Today, we would probably think she's getting ready to pull out a gun and, go do bad stuff. But, she just mumbled and walked around and just like kind of cursed under her breath all the time. And this woman would, I'm a college kid at this point. I'm sitting there going, I don't want this job. I don't want to be there. I don't want to go into that permanently. So I went to grad school to, make sure I was very clearly going to cut a line from involvement there to go and do something else. It's just not going to happen. So crazy. Yeah.
Wow.
You kind of discussed there, or you did say what your kind of deciding factor was to get you to leave. That was a definable moment. But as you're doing that, as you switched over to your new path of just from the passive investing and building up that portfolio, what was your first victory you can think of when you started down that path that solidified for you that you'd made the right decision and this was what you wanted to move forward with?
Yeah, well, so it's kind of my story is somewhat interesting in that when I left the corp world in mid-07, I had enough cash flow built up to live off of, but I was a very low risk guy. And I had about 2 times cash flow coverage to cost, which was really important for me to have. But what's crazy is that at that time, it was June 2007. My wife was going to leave her job to have our first kid in October. I was fully expecting a recession. And so we were going to lose my salary, and have a kid at the same time. And so I'll just say that once we got through about a year or two, and actually the cash flow sustained through the downturn and everything else, that's when I realized that once I got through that downturn, that I was in a place. First of all, I loved what I was doing to begin with, but the more important thing is that it sustained the family, right, economically. And once I was able to get through that period, that's when I realized that this is probably here to stay if I can make it here to stay. The challenge I've had since then is how do I continue to build my cash flow snowball, so to speak, so that I never have to go back to the corporate world. That's literally been my goal from the day that I left the corporate world. And so once it got large enough and I got pretty comfortable with it, and it took a few years, then that's when I knew I was going to go down this path for a long time.
It's a huge accomplishment to be able to, quit 2 jobs, have a baby, and again, live off of your investments, as well as obviously generate additional cash flow to cover everything. So that's fantastic that's worked for you. I mean, it just in that time that was around the housing crisis and et cetera, that, wound up obviously tanking the economy in many respects. Did you have dry powder on the ground? Were you able to pick up some, appropriate investments in that, when everything went on sale, as they say?
Yes. So what was really annoying to me, which is even worse this cycle, is that between 05 and 08, I was on the sidelines with a lot of stuff. And I was very young back then, and I hadn't had my first kid until 07. And essentially, I was going to like a dinner party at 05, very young in my 20s. I turned to somebody and said, there's going to be a really bad housing crash. And they'd all look at me like I was nuts. So this went on for years, right? So I was just patiently waiting for years, which is what I'm doing right now, which is what I've been doing since 2017, basically. So I had dry powder, but it was a very agonizing wait, similar to what I'm going through right now. So.
Yeah, it's no fun. Obviously, you do look for those sales. You want things to go on sale, but at the same point in time, you obviously don't want to see, crazy, ridiculous cuts and drops. But yeah, it is frustrating when you got dry powder. So yeah,
I'll tell you what's even worse right now is what's going on with inflation, right? It's one thing back in 05 and 08 where we didn't have crazy inflation. Now I'm just sitting on cash, and it's actually getting eroded even worse. Now, look, I still make investments. I don't not make investments, but I have to kind of pivot and look at different buckets that can make sense and try to figure out what makes sense in the short term. But my favorite opportunities are longer term passive cash flow opportunities that are more predictable and more stable, which is why I got into all this in the first place. And that's not something I can get comfortable with right now, except for the odd exception. There are exceptions. So.
Right.
Yeah. I was going to say, it's almost like, it's a yield starved environment. I was just looking, the 10-year was 1.45 today. I mean, you compare that with, a headline 6.8% inflation, which is probably quite a bit higher than that. To your point, you're sitting in cash is kind of eroding that purchasing power unless you have some hard asset or some cash flowing way to kind of offset that.
Yeah. And I would say this to everybody who's listening, that 6% inflation number is obviously understated. And I think most consumers know that. I would highly encourage, and I'm not affiliated with them, but if you want to see what the real numbers are, go to a website called shadowstats.com. They will publish variations of the CPI based off of the way it used to be calculated and with certain adjustments. And what's so fascinating, if you think about it, is that the last time the government adjusted CPI, I think in a major way was 1982. And that was, of course, in the era of inflation in the past where they wanted to conveniently bring some of the numbers down, right? So they just changed the calculation. I've actually read an article recently that they're considering changing the bucket again right now. And they might even recast 19 and 20 if they do that. And it's something that's under consideration right now.
Which is insane that you have no predictable thing to measure each period of time by, right? Okay, we'll remove gasoline, remove, food cost. I mean, well, everybody has to have gasoline and food costs. So why it's not actually in the bucket makes no sense. I mean,
Yeah, between, if you look at everything that's outpaced inflation by a long shot, and this is before all this inflation even happened right now, which is housing, medical costs, and education costs. Those three, I mean, everybody knows it. It's not a secret. It's been happening for a long time. All the charts exist, right? And but I mean, at the same time, I can't blame the government for doing what they can. I mean, there's a lot of reasons why things happen in politics. I'm not a big fan of politics at all, and I don't even take a side because I just done with the politicians, and the way it is. But you'll see on Shadow Stats that we're somewhere between 8 and 11% real inflation right now, which when you think about it, that means that if you're going to make an investment and it's going to cash flow, if you're not at that post-tax, 8 to 11%, which is very difficult to achieve, then you're falling behind realistically.
Right. That's a scary thought. Yeah.
It is. Yeah.
So Jeremy, in your endeavors since you retired from the corporate world, you've obviously been able to carry forward as, supporting your family, things like that. Have you experienced any humor along the way? Any funny stories that you can share? Something along there?
God, trying to think of one offhand. I mean, I could probably think of a lot of different stories. Trying to think of my best investing story. I mean, I have it was my only foreclosure, but I was involved in a 303 unit apartment building and student housing. And it's funny because I made this investment in January 2008. It was a very unusual circumstance. We were assuming a loan with a partnership dispute. We got a really good deal. And my thesis, frankly, was that during a downturn I thought was coming up at that time, that people would go back to school and that would be highly occupied. And it's exactly what happened. It was to a T. And we were like 100% occupied. So we were the first property across from a state university campus in Michigan. And 4 years later, the spring comes around, we're like 100% occupied. And a letter comes from the city to all the residents and to the owners. And it says, we need to close the bridge to campus for repairs in the summer because the cold weather, we have to do the weather, we have to do the work in the summer. And, but don't worry, the bridge will be open in time for school. You'll be able to go to school, right? So we go from 100% occupied to 65% occupied. So that's like the first domino that falls, right? And then the second domino that falls is that the loan that we had assumed happened to be due that fall, okay? So the appraisal was going to come into the new occupancy rate, right? The third domino that fell was that the bank refused to extend the loan for a year, even at a cost, right? Because they wanted the property. So we ended up foreclosed. It was the only foreclosure I've ever been in, and what I call like a 1% risk. And, I invest in a lot of stuff that's like 80 to 100% occupied, stabilized, and has low risk going in because it's already stabilized and there isn't a huge value add component to it normally. But I always tell people there's all these 1% risks in investing. And that was my 1% risk situation with the one foreclosure I was in. Very lucky because the operator felt really bad for the investors. They actually had a partial recourse loan they had to pay themselves. And they completely willingly, with no legal obligation, proactively transfer everyone's equity from that property to another property they own themselves with no other investor. It was the first property across the street from a state university in Texas that I'm still in today, that still cash flows today. So the net effect on me as an investor was just a year of no cash flow as all the legal and accounting got sorted. That was very lucky. But, I tell everybody that investing is actually, Bill, it's actually like airplanes. And I truly always use this analogy where if you're investing in a stabilized property that's 100% occupied in a really strong growth market, it's like you're investing in a brand new airplane with all the modern technology, with all the redundancy in the world. And like 5 dominoes have to fall before you crash because of the backup systems and everything else, right? Whereas if you're doing a development deal, you're investing in an airplane that's maybe 40 years old, that's been through several owners, that might be in, not the best shape. And maybe only 1 or 2 dominoes has to fall for that airplane to crash, right? And so So to me, that was the one time where I had the brand new airplane and the 6 dominoes fell. It was like the perfect scenario. And then that happened. So I wouldn't say it's such humor, but it is an interesting story. It's very unusual.
Well, it is. I mean, it's like the perfect storm. I mean, how could anybody have ever expected all of those, negative events to line up at the same time? And I'm sure that bridge did not get done during the summer.
It actually, no, it did. That's what the crazy part was. It did.
Really?
And so the bank took the property back with the full knowledge that if they just kept it to the next summer season, they'd be back at 100% occupied. They were going to make a ton of money. Right. And that's what happened. But, it is what it is.
Wow. Yeah.
Wow.
Yeah.
Well, that's like, and you read about that stuff too in the 2008 time frame that people had perfectly performing loans, and then they just their debt became due at that point to refinance, and the credit markets were seized up, and no option, they lost perfectly performing properties.
There was an apartment building. This is not an exaggeration that they were building around the corner from me, and I live in LA, and it was, call it brand new construction. Let's call it a 60 unit building, might be somewhere between 40 and 100 units, and brand new construction. They had multiple construction tranches they'd gotten. They were onto their last tranche, the last 10%, that literally was involved landscaping and other miscellaneous items. And when the whole credit froze, they could not complete the landscaping to get the certificate of occupancy, and they didn't have the capital, and it foreclosed based off of the last tranche of like a perfectly looking, ready to live in building that just didn't have the landscaping. There were some crazy stories from back then.
Right. Yeah. That's it. It's crazy. I mean, like you said, when the opportunities arise, but then everything, it's usually at the same time that credit markets are frozen up. So if you happen to have cash, you can capitalize on them. But then there's so much fears why there's opportunity. So it's always an interesting dynamic as that unfolds.
Yeah, you will see that Warren Buffett's cash is king. He's been taking that approach for a few years now, waiting. He will be rewarded for his patience at some point.
Right. It is funny because I follow a lot of his, investing that he's done over the years. And every time this happens, everybody says, oh, he's lost his touch. And then, some crash happens. He buys everything in a bargain and he's good again. But people they don't have the same horizon he seems to be able to have, or the patience he seems to have, I guess, more to the point. Yeah.
It's too bad Rent-A-Plant wasn't around during that issue where those guys had a problem. They could have just rented the plants, put a deferred payment, 90-day payment plan, and could gotten their CO. Come on,
That's funny.
Oh, geez.
Well, Jeremy, where are you today in your journey as a passive investor? You said you're looking at different opportunities. Is there any specific kind of opportunities you're looking at, or how you're looking to grow the portfolio?
Yeah, absolutely. So what's been really challenging for me is that I'm the guy, again, that likes to go into a fixed rate loan, longer term 10-year fixed rate if I can, more predictable cash flow scenario because I live off the cash flow and I want to go to sleep tonight, wake up tomorrow, and not much has changed, right? Because I'm depending on those payments. But that's been really challenging for me based on where pricing is today and for other reasons. So I've kind of been doing 3 different buckets that I've been considering investing in just to pivot the past few years. So the first is short-term stuff that I feel like has a good risk-reward profile that I'm going to get my capital back quickly, or is short-term so that the risk comes off the table relatively quickly in case there is an adjustment in the markets, right? And so a great example in 2021 was I did about 2.5 times more hard money lending than I normally do, which is basically loans against first positions for flips of single family homes. And the reason why I really pushed the envelope was because the supply and demand imbalance in the single family market led to huge price increases, which is a great scenario for someone who's lent money in a property that's increasing in value, right? So that's bucket number one. Bucket number two is opportunities, and I do stuff that's also not in real estate. So opportunities where I don't have to worry about an asset depreciating or going down in value, which is my major concern right now, right? Because I'm waiting to see if there's going to be asset price adjustments based on interest rate increases, and I cannot absorb those because I do a very stabilized approach to my investing, and there's not much value added in. So I have to be really careful what to buy, just like Warren Buffett. And so I'll look at stuff where I don't care if the asset prices or values go down. In that if it still performs for another reason, that'll be fine. So great example is I've been investing in ATM machines since 2008. And what I depend on in that is the transaction volume continuing at that ATM machine, because I get a portion of the surcharge of the fee at that machine. We know the computer equipment, all that is like computer equipment, a bill feeder and a case and a screen. those are going to depreciate to almost zero. I don't care if the screen is worth $50 less because of a recession or not. It's going to zero in a few years anyway, right? For all intents and purposes. So if I think that the transaction levels are sustainable with a nice buffer, then that's another good example of stuff that I have been continuing to invest in despite my concerns about where we may be heading. And then the third bucket would be unusual or unique opportunities that provide padding, but not in a way that really increases risk to me very much. So really good example is I've actually invested in a whole number of tax abatement and low-income housing tax credit apartment opportunities in the past 12 months. Those are meant for downside risk protection in the event of a downturn. The tax abatement deal has been extremely unique where these are true story. I've been in a brand new 2021, 99% occupied Class A building that was purchased well below market rents, which work for the tax abatement structure because you're basically turning a building from a regular rental building into about 50% rent restricted. And so you have rent caps. But anyway, long story short is that, building was purchased, I think, for $77 million. It was appraised for $117 million or something like that. The reason is because it was purchased at a regular cap rate, but once the tax abatement structure was put in place with the housing authority, it reduced the taxes by 75% and eliminated the expenses by 20%. And so we didn't have to reduce any of the revenue because it was already way below market rents, but we actually got to reduce a ton of expenses. And this is prior to closing. So there was no operational execution risk. So what that does for me is it literally created a situation where we had 2-to-1 equity coverage. There was 17 million equity invested. I'm giving you some of the wrong numbers, but it was 34 or 35 million equity coverage based off the appraisal that was done by the FHA or Fannie or whatever. So long story short is that gives me padding in case there is a price adjustment. That's what's more interesting to me than the fact that we have the built-in equity going in is what happens if prices change. So I'm willing to do those because that helps to mitigate risk and there's no executional risk, right? It happens at closing. But they're very unusual, very hard to find. So you always have to be open-minded at any point in the cycle to opportunities because they're always out there. Just there's times at which they're much harder to find than others. So,
yeah, that's great. That's a great example. Three different ways and unique opportunities you're viewing them. Yeah.
I'll tell you what I'm really worried about though, is being a cash flow investor. I think once we get through with some type of adjustment, we really enter to the next cycle, whenever that is. I think the next cycle will be very low economic growth. I'm projecting about 0.5% to 2% annualized GDP growth, depending on the year, which is lower than the previous cycles we've had. And then I'm really concerned about the cycle after that. That's when I think we start to turn into Japan, unfortunately, and where we could have, any random quarter of GDP plus or minus 1%. And not only does that result in lower cap rates, higher asset prices, and very low cash flow returns, but a lot less predictability of a cycle. Because right now I can go investing in a cycle with the thought process that the economy is going to increase every year. We're going to be able to increase and keep up with inflation on the rents, and the cash flow will increase slowly over the years, right? And that's important for me. But that predictability and certainty, I think, is going to go away after the next cycle. I mean, that's my current concern. It could change over time, and if that happens, I may have to switch my entire investing philosophy from cash flow to something else, whether it's more appreciation or a hybrid or what it's going to be. But that's probably going to be in 10 years from now. But it's still a big concern of mine into the long term.
Right.
Yeah, I honestly think that the growth numbers have been pretty weak over the past, I don't know, at least 10 years. Even since the housing recovery, the numbers have just been very weak. And I want to see we want to see the 3+% GDP growth, and not necessarily 5 or 6, but we want to see at least 3. That's a good metric.
I don't think that's going to be achievable realistically, only because a combination of demographics and the debt overhang. And I think that's why I'm projecting the 0.5 to 2% annualized GDP growth. It's purely based off of those two factors combined. We've gone from 4% GDP potential in the 2000s to 3% in the 2010s, as a maximum, to what I think is going to be 0.5 to 2% in the 2020s. And that's my point, is like, okay, what happens after that? Because the government is continuing to print money. That's not stopping anytime soon, it seems. That's the politicians' favorite method. And as long as that doesn't stop, the debt overhang is going to affect us more and more and more.
Right. Absolutely. Wow. Yeah.
Interesting, concerning thoughts. Yeah, for sure. So Jerry, I mean, just as you're out there in the world and, you're taking care of your family, et cetera. Is there anything that you do that you can share that you do to try to give back to help others in some way?
Yeah. So, I spend a lot of time throughout the year, speaking to relatively new passive cash flow investors to help them out. I love the fact that I'm in a position I can help people with the 20 years of just experience. I just have knowledge from experience and networking, so I just have the benefit of time. And I don't charge for any consulting or whatnot. I'll just take someone's call and try to help them any way that I can. And so I don't know how many hours in a year I do, but I probably do 5 to 10 hours a week or more of just calls like this for free. And so that, yeah, and frankly, like even this podcast, I mean, what all I care about on this podcast is it's helping your listeners, right? And so I've been on over 100 podcasts for the same reason. It's like, if I could share some information that's going to help somebody, great, because I've had the experience, and I have the ability and time to do it. So those are just some of the ways.
Well, that's great. And quite honestly, that's exactly why we do the podcast, is to help serve as an education platform to others, so that they can learn from, experience of others and really take some ideas, some nuggets, and be able to carry forward and apply it to their situation. So yeah, certainly appreciate you being here today for that reason.
Yeah, well, kudos to you guys for putting the platform together and doing this to help people, because the funny thing is one of the top recommendations I have for new people to go listen to some podcasts, because they're just an immense amount of information shared. And when I first started, none of that was available, right? So it's amazing that, very nice you guys make this available to everybody, and it's free, and it's just amazing resource.
Thank you. Yeah. Well, Jimmy, is there something you've recently implemented in your business that's helped you scale or grow as you're expanding?
Yeah, I wouldn't say necessarily help me scale, but those 3 categories I mentioned, those 3 buckets, that allowed me to pivot in a very challenging time in the cycle for me. Because as I mentioned before, I've been on the sidelines pretty much like psychologically since the end of 2016 is when I was worried that asset prices were too high in most of the asset classes. And so I had to figure out what to do. And it took me a little while to formulate those buckets, right? Because it takes time to figure out what makes sense. But having those 3 buckets really defined helps me a ton, because when I get an opportunity now, if it doesn't fall under one of those 3 buckets, it can be filtered out very quickly. And that's really key, because if you don't have those filters, you're gonna be like a squirrel looking at like 5 different things and pulled in all different directions, and that's not good. Especially not if you want to be a really disciplined investor, right? And I think the same goes for someone like, I keep talking about Warren Buffett. It just happens to be an easy example coming back, but he probably does a similar thing. He's got very strict filters and he's holding to them, right? But he's got those strict filters in place that he will not deviate from. And so for me, because of that, I had to pivot in 17 and create new filters. And that's been extremely helpful, allowed me to deploy a pretty good amount of my capital. I'm still deploying less than I'd like to, but it's been extremely helpful to have those specific filters in mind that are very, very set in stone.
And I remember Warren Buffett always talking about one of his newsletters about, the circle of competence, right? It doesn't matter how big your circle of competence is, but it's critical you know where the boundary is. So you're not investing things you don't understand. It's critical that you only understand 3 companies really well, but you can do well in 3 companies, then that's all you need. But that makes so your 3 buckets, like you said, you have that filter system and process down to what you really have or really see where the opportunity is. Is that the fairly equal weighting, or is it just kind of as you happen to find the deals, one of those 3?
You're right. And so that's one of the things about being a passive cash flow investor. You can't really say to yourself, you can't wake up and say, it's 2022. I'm going to invest in 3 apartment buildings and 7 mobile home parks and 4 self-storage facilities like this year. Because if you're doing that, you're actually it's the exact opposite of the filter system, right? Because then you're actually forcing those things to happen. I have no idea what I'm going to find in a given week, and it all comes from all the networking. And so I have to respond to it, but I have to be very disciplined about it. So yeah, those filters are absolutely critical in that type of process. But it allows me to be reactive, but in the right way,
Yep, that's great. Yeah.
Jeremy, you mentioned that you do calls every week with people, trying to help them and give them some inside advice. And can you share, maybe a nugget now as far as what you would tell someone who's looking and considering making a path change? What would you tell them?
Yeah, absolutely. So are we referring to an accredited investor or non-accredited investor?
Anybody.
Okay, I'm going to take accredited because it's a little easier.
Sure.
Non-accredited is a very hard landscape for them right now in this type of investing. So the number one suggestion I always make, and again, I'm not a financial advisor or anything, but the number one suggestion, the first step for somebody who is interested potentially in investing passively, regardless of whether it's for cash flow appreciation or whatnot, is I tell people, look, focus on one asset class first to learn it really well. And I normally recommend the asset class that they already understand best. And the one that a lot of people tend to default to actually is apartments, because a lot of people have either lived in an apartment or understand apartments really well. can understand the business model behind apartments, and they can get their arms around it very quickly. But I would say to somebody, look, if you grew up in a mobile home park your whole life, focus on mobile home parks first, because that's what you understand, right? So focus on one asset class, learn it as well as you can for a time period. And what's really cool is that when you focus on one asset class, I would say about 80% of that is transferable to the other asset classes. Every asset class has rent and inflation, expense assumptions. All of them have a expense ratio. All of them have going in and exit cap rates. There's a lot of similarities across them with some tweaks. So focusing on one asset class first. Don't start looking at 3 different asset classes, because you're not going to be able to learn that, I think, well enough and really focus properly first. So build that core foundation and don't jump in. There's no need to jump in quickly, especially not at this timing, right? And so, in fact, some would argue that at this timing, you have to jump in very slowly as opposed to very quickly, right? This isn't 2011 where you're going to miss the boat. This is 2021, 22, where we're not quite sure what's about to happen with interest rate increases. So just make sure you take enough time to learn and do not invest unless you're 100% comfortable, because of the illiquid nature of these types of investments. You can't just press sell on your computer screen and get out of these very easily. So,
right. Absolutely. Well, Jeremy, what's the best way for our listeners to be able to reach out to you and connect with you?
Absolutely. So like anyone's welcome to contact me if you're brand new and just want to brainstorm, if you're experienced and you're an investor group, or if you're a sponsor and just want to network, or just even other investors that want to network, just don't hesitate to reach out. Best way to reach me is my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com.
Very good. And we'll put that link in the show notes below to make it easy for listeners to be able to reach out to you. Well, Jeremy, really enjoyed the conversation today, and wish you continued success.
Yeah, guys, thanks again for having me on. I just hope this is helpful for your listeners.
Absolutely. I'm sure it was. Yeah.
Yeah, absolutely. I think there's definitely some great info that you've been able to share, and we certainly appreciate you doing so. We'd also like to thank our listeners for being on the show or listening to the show. Please continue to give us a 5-star rating so we can bring you more great content like Jeremy Roll today. We'd also like to thank our show sponsors, which are Park Capital Partners. We enjoy doing the show. We're glad to do it. Please don't forget about our Park Capital Value Add Fund. It's a 506c fund. And finally, we'd also like to mention and thank Park Capital Partners Foundation, which is a 501(c) nonprofit, which is one of the ways that Bill and I give back. Thank you again, Jeremy, so much for being on. We really appreciate it. And remember, folks, the road less traveled may be calling you. We recommend that you listen and take action. Thanks for being on.